America is now spending an astonishing amount of money just to keep its debt machine running. Not to pay the debt off. Not to reduce what it owes. Just to service it. And that number keeps climbing. Now here's the problem. The next Fed chair may be under enormous pressure to bring interest rates down. Lower rates would ease stress across the economy, calm markets, and reduce short-term funding pressure on Washington. But there's a catch. If rates come down too fast, inflation can heat back up. And once inflation starts moving higher, bond investors usually demand higher yields to lend money long-term. That pushes up the government's borrowing cost right when the debt load is already massive. So the next Fed chair could be walking into an impossible equation. Cut rates, but don't restart inflation. Let inflation run a little, but don't let long-term yields explode. Help the government finance itself, but don't look like you're monetizing the debt. That sounds impossible, but there is a path through this mess. The issue is, if this is the path policymakers choose, the burden probably won't fall on Washington first. It'll fall on the value of your money. And in this video, I'm going to show you exactly how that works. Before we talk about the possible solution, we need to understand the trap. The U.S. debt load is now so large that even small changes in interest rates matter. When debt is manageable, higher rates are painful but survivable. When debt gets this big, higher rates start behaving like a structural threat. That's because the government doesn't refinance all its debt at once. It constantly rolls it over. So as old low-rate debt matures and gets replaced with new higher-rate debt, the interest bill climbs. That creates a policy nightmare. If the Fed keeps rates high, financing costs keep rising and economic pressure builds. If the Fed cuts rates aggressively, it may weaken confidence that inflation is under control. And if inflation expectations rise, long-term Treasury yields can move up even if short-term rates move down. That is the real danger. Because once long-term borrowing costs rise, while debt is already huge, you start entering the zone where debt itself becomes the problem-driving policy. That's when governments stop thinking like normal borrowers and start thinking like over-leveraged ones. When a country is buried under debt, there are really only 4 broad ways out. The first is the clean option. Run budget surpluses, cut spending, raise revenue, and slowly pay the debt down. In theory, that's the responsible route. In reality, it's politically brutal. Cutting spending at scale is unpopular. Raising taxes meaningfully is unpopular. Doing both at the same time is even harder. So while this sounds good on paper, it's the least likely outcome. The second option is default. That means failing to pay creditors as promised. For the United States, that would be catastrophic. Treasury securities sit at the heart of the global financial system. A true default would blow a hole through banking, collateral markets, pensions, and international confidence in the dollar system. So yes, default is technically an option. But it's the kind of option policymakers only approach if everything else has already broken. The third option is to outgrow the debt. This is the optimistic scenario. Productivity surges. Innovation explodes. AI, automation, energy abundance, and industrial growth lift GDP faster than debt rises. That can help. And over long periods, growth absolutely matters. But growth alone usually doesn't solve a debt burden this large fast enough, especially when deficits continue running in the background. That leaves the fourth option. And this is the one governments have turned to over and over in history. Reduce the debt burden by reducing the value of money. Not officially, not with a headline that says, "We are devaluing your savings," but quietly, through inflation, low real yields, and a system designed to keep financing conditions manageable while your purchasing power does the adjustment. That's the path most people underestimate, and it may be the most realistic one. Let's make this simple. Imagine you borrow $500,000 to buy a house worth $500,000. At that moment, your debt equals 100% of the value of the asset. Now imagine a few years pass. Because of inflation, wages rise, prices rise, and the house is now worth $550,000. Your mortgage balance may still be close to what it was, at least compared with the rise in the home's price. So even if you didn't become more disciplined, and even if you didn't aggressively pay everything down, the debt feels smaller relative to the asset. The number didn't vanish. The measuring stick changed. That's exactly how inflation can help governments. Government debt is fixed in nominal dollars. But GDP, tax receipts, wages, and asset prices can all rise in nominal terms when inflation moves higher. So if inflation lifts nominal GDP faster than debt grows, the debt-to-GDP ratio starts to look better. From the government's perspective, this is incredibly useful. From your perspective, it's a hidden transfer. Because the debt burden is being reduced in real terms partly by making every dollar you hold a little less valuable. That's why inflation is never just a statistic. It's a mechanism. This is not some new theory. The United States has already dealt with a debt burden this large before. After World War II, federal debt relative to the economy was extremely high. Policymakers faced a familiar problem. The country had too much debt to simply power through it painlessly, but allowing borrowing costs to rise too much would make the whole situation worse. So what happened? For a period of time, rates were held unusually low relative to inflation. Financial conditions were managed. The government financed itself cheaply. And over time, the debt burden came down relative to the size of the economy. That was good news for the government, but not necessarily for people sitting in cash or fixed income assets, while inflation eroded purchasing power. This is the important lesson from history. A government can reduce debt pressure without paying down debt in the way most households think about it. It can do it by engineering an environment where nominal growth rises, financing stays manageable, and savers absorb part of the adjustment. This is why debt crises in advanced economies often do not look like dramatic collapses. Sometimes they look like years of slowly stolen purchasing power. Slow enough that most people don't frame it as a policy choice. But that doesn't make it any less real. Now, we get to the modern version. If the next Fed chair wants to help stabilize the debt problem without openly restarting a giant money printing campaign, the approach would likely be more subtle than the last crisis cycle. Think less about one dramatic announcement. Think more about a framework. That framework could involve 3 broad moves. First, lower short-term rates when economic weakness or fiscal stress gives the Fed political cover to do it. Second, avoid a disorderly spike in long-term yields through coordination, balance sheet design, regulation, or market incentives. Third, create conditions where inflation runs hot enough, or real rates stay low enough for the debt burden to erode over time. That combination is powerful. Because if the government can borrow at rates below the pace of inflation for long enough, then the real value of that debt shrinks. That doesn't mean everything will look chaotic on the surface. In fact, the most effective version of this strategy is one that looks almost boring. A few rate cuts here, a regulatory tweak there, a Treasury maturity adjustment, some market language about stability, liquidity, or efficient transmission. But underneath it all, the same outcome is being pursued. Keep the debt financeable. Keep the system liquid. Let inflation do part of the work. Here's the real question. If deficits remain large and the government keeps issuing debt, who absorbs all of it? That question matters because if private investors demand much higher yields, then financing becomes harder. So policymakers need reliable buyers. One way is obvious. The central bank can buy bonds directly or indirectly through renewed balance sheet expansion. But that approach is politically controversial, especially after years of criticism around quantitative easing. So the more interesting path is to create a system where other institutions do more of the absorbing. Banks, money market funds, pension structures, regulated financial institutions. Buyers who are either encouraged, incentivized, or positioned to hold more government paper. This is where policy gets technical, but the effect is simple. If enough institutional demand is directed toward treasuries, long-term yields can be kept from rising as much as they otherwise would. That gives the government breathing room, and it allows officials to say, we didn't monetize the debt. Maybe not directly. But if the system is shaped in a way that channels balance sheets toward government debt, while inflation eats into the real burden, the economic result is not all that different for ordinary people. The financing burden stays manageable for the state. The purchasing power burden lands on the public. That is the key idea. Now let's bring this back to everyday life. If this type of policy mix takes hold, what gets hurt first? Usually it's idle cash, then low-yield savings, then fixed-income assets that don't keep up with inflation, then wages, if they lag behind the rise in living costs. This is why people often feel poorer even when the economy sounds fine in official commentary. Because on paper, nominal growth may look okay. But if your income rises 3% and your true cost of living rises 5% or 6%, you are falling behind. And when governments reduce debt burdens this way, they rarely call it sacrifice. They call it resilience, adjustment, recovery, normalization, soft landing, financial stability. But if your money buys less, the label doesn't change the outcome. That's why this matters so much for households and investors. A debt solution for Washington can become a wealth problem for everyone else. And the people who do best in that kind of environment are usually not the people who sit still. They're the people who understand the regime change early. If the next phase of policy really is some version of financial repression, then the big question becomes, what survives at best? Historically, assets that have some inflation sensitivity tend to hold up better than static cash piles. That can include productive equities, especially companies with pricing power. It can include real assets. It can include certain commodities in the right cycle. It can include businesses that can pass rising costs on to customers. The exact positioning depends on valuations, timing, and risk tolerance. So this is not a one-size-fits-all formula. But the principle is straightforward. If policymakers are solving debt through the slow erosion of money's value, then assets tied to nominal growth usually have a better chance than assets stuck at fixed nominal returns. That doesn't mean every stock wins. It doesn't mean every hard asset is automatically safe. It means the environment starts rewarding ownership over passivity. And that's a huge mental shift most people make too late, because they're still thinking in a world where preserving cash feels safe. In a financially repressed world, cash can become the asset that quietly loses. Here's the uncomfortable truth. The next Fed chair may not need a perfect solution, only a politically survivable one. And those are very different things. A perfect solution would mean restoring fiscal discipline, protecting purchasing power, maintaining growth, preserving market confidence, and reducing debt honestly. A politically survivable solution is simpler. Keep the system functioning. Keep Treasury markets stable. Avoid panic. Reduce the debt burden gradually in real terms. Let the public absorb the adjustment without calling it austerity. That strategy has a long track record because it works well enough for governments. Not perfectly, not cleanly, but well enough. Which is why the question is not whether policymakers would consider it. Of course they would. The real question is whether you recognize the signs early enough to respond before the cost shows up fully in your own financial life. Because by the time everyone agrees inflation is back or that real returns have been suppressed for years, the transfer has already happened. Quietly, gradually, systematically. That's how these regimes work. So let's bring it all together. America's debt problem is too large to solve with easy slogans. Paying it down cleanly is politically unrealistic. Default is unthinkable. Outgrowing it would help, but probably won't be enough by itself. That leaves the strategy governments have used before. Hold financing conditions together. Keep real rates low enough. Let inflation and nominal growth shrink the burden over time. If the next Fed chair moves in that direction, it may be presented as stabilization. And for Washington, it probably will be. But for savers, workers, and anyone holding too much dead money, it could mean a long stretch of purchasing power erosion. That's the part most people won't like. Not because the policy is shocking, but because it's effective, and because the bill may not arrive as a tax notice. It may arrive in the form of higher prices, weaker savings, and money that simply doesn't go as far as it used to. That's the game worth watching now. Not just whether rates go down, but who benefits if they do. If you want more breakdowns like this on macro trends, debt, inflation, markets, and what they mean for your portfolio, Subscribe to Matt FinLab. On this channel, we don't just follow headlines. We break down the machinery underneath them so you can think ahead instead of reacting late. And if this video changed how you think about the Fed, debt, and the value of your money, let me know in the comments. Do you think the U.S. will solve its debt problem through growth, inflation, or financial repression? Thanks for watching, and I'll see you in the next one.